Two stocks I own with massive upside potential. One of them, I talked about it 2 months ago. I said this is my 20x stock, and I talked about it on YouTube. It has over 20x on the upside, and now it's starting to go down. It went down 14% today. So I think this is a good time to start talking about those stocks again. The second one is a stock that I've been talking about for almost 3 years on YouTube, and I still believe it's presenting a great opportunity. And I normally have a good track record of picking those early winners and sharing them on YouTube. My biggest one has been Hims and Hers. A lot of you guys know me for the stock. I'm up 640% from a $7 cost basis. Mama is up 550%, and Robinhood, which I bought in April, and I shared it on YouTube around $42, and it was a hated video. Now it's up 370% since April, and I'm gonna share this one today again, and maybe it's one of those huge winners for me, or maybe it's potentially a big loser. I'm excited to find out. But before I get into the details, I just want to mention that I have a small percentage of my portfolio invested in those, you could say, high risk, high reward stocks. Most of my money is in a lot of safer stocks, high quality companies, some of the big 7 stocks and other stocks in general. But I have a small percentage of my portfolio. You can call them moonshots. You can call them, high risk, high reward, or wild cards, where if I'm right, I could make a lot of money, 10, 20x on my return. But if I'm wrong, then I don't lose too much because it's a small percentage of the portfolio. So this is how I structure those trades. I know that they are high risk, high reward, so I try to reduce my risk through having a smaller position sizing, but I really hope you enjoy it. Now, the first one is mainly a bet on automation. I'm a big believer that automation is a huge mega trend that's in its early innings. It's only beginning, and there's a lot of things playing around it, mainly a lot of the immigration law. So we have a lot of deportations, and that could potentially reduce the workforce in the United States. But at the same time, we have a lot of reshoring into the United States. We have more factories coming in, a lot more potential job opportunities coming in, but a lot of potential employees, they're leaving the country. So this is a very interesting dynamic where we desperately need automation. We desperately need automation in warehouses, in factories, in deliveries, autonomous drones delivering food to people's door. This is the future. Or a lot of the autonomous robots delivering, or maybe you've seen the Amazon robots. All of those things, they have to be automated. But I did not want to invest in a company that makes a robot, because it's like betting on really, I would compare it to NVIDIA. Okay, so NVIDIA, what they're doing is they're mainly selling shovels during the gold rush. So the gold rush is here. It's AI. Google is spending $100 billion in CapEx. Microsoft and Meta, they're spending $80 to $100 billion in CapEx. They're doing all the hard work. They're building the data centers. They're putting all the heavy CapEx. NVIDIA is selling them the shovels. They're selling them the chips. So I want the company that's selling shovels during the rush of automation. And all those robots, all of them pretty much, they need one thing. They need sensors, and mainly LiDAR sensors, which is why I invested in a company called Ouster, ticker symbol OUST. This is over a $70 billion market opportunity, and the company's revenues is around $165 million. So you can see the potential upside from here is absolutely insane. Their first segment is the robotics segment, which is a $14 billion TAM. So if you've ever seen a lot of the Serve robotic robots, or other companies, they make them also. But if you've ever been in San Francisco and in Las Vegas and other places, you likely have seen a lot of those delivery robots. They're delivering food to people's doors or whatever autonomously. But they have this sensor here. This is an Ouster sensor. And this is mainly for last mile delivery, mapping, military and defense, asset inspection, and a few other things. This is a $14 billion TAM. The second one is industrial. Industrial is a huge one for the company. They specialize in industrial. And this is, if you again look at the sensor here, it's mainly a lot of things within warehouse automation, agriculture, mining, and construction. The third segment, which isn't a big part of the company, is the automotive segment. Now, the automotive segment is very competitive. And this is a mistake people make when I mention Ouster. They say, oh, but everyone is making those sensors. Everyone is selling them. They're not doing anything special. I'm going to explain a little bit what's special about this company, but they're not really big in automotive LiDAR. Automotive LiDAR is where you have a lot of low margin. In fact, a lot of automotive LiDAR players have negative gross margins. They're not even making money compared to Ouster. I could show you the chart. It's not even close between Ouster and the competition because it's so competitive. Ouster is not in it. Ouster specializes in industrial LiDAR and a lot of things within robotics. This is where they have a technological edge and they have a competitive advantage. So they are entering now, you could say, the automotive space, but this is not their specialty. Their specialty has always been industrial LiDAR, which is what I want exposure to in terms of automation of factories and also robotics in general. The last segment, or not really the last segment, but you could say my favorite segment, is the smart infrastructure. So smart infrastructure, this is, you could say one of the most bulletproof, recession-resistant business models. And they're pretty much selling those sensors to be used for traffic monitoring. So a lot of the traffic monitoring systems, as you could see this one on the traffic lights, they're really, really old in the United States. And a lot of them need updating. And this is a huge area for Ouster, and it's my favorite area. The reason why it's my favorite area is Ouster is not only selling them the sensors for the traffic monitoring system or smart infrastructure, they're also selling them the software with it. So there's not only a hardware business, it's also a software business. And a lot of the cities and local officials, they use the Ouster software. They pay software recurring revenue fees pretty much every single month for them to use the software to be able to access the best of those sensors, to be able to monitor traffic, monitor a few more things within the intersections. So this is a huge business for Ouster, and it could allow it to have much higher gross margins over the long term. So over the long term, it's a very sticky business. It's not just a hardware company, but it's eventually going to transition into a software company, which is what I really like and what really differentiates Ouster between Luminar and a few of the other LiDAR players. And this segment for Ouster has been doing extremely well. And I'm going to read some things from the latest earnings presentation. And it says, starting with software attached business, in 2026, the world's most watched sporting event is coming to the United States, the FIFA World Cup. We won an award to deploy Ouster F7 and Blue City across dozens of sites at a World Cup host city to bring real-time on-demand traffic data to reduce congestion and improve safety for visiting fans. We also recently expanded an agreement with the Utah Department to bring Ouster to over 100 intersections. They started with like 10 intersections. Now they're around 100 intersections. Not a lot, but it's an improvement. And they also signed 3 exclusive partnerships to bring their technology to Texas, Michigan, New York, and Pennsylvania. So you can see how rapidly this business is expanding. It's small, but it's expanding. And the FIFA World Cup will help them in a major way, because if this gonna be a success for Ouster, a lot of other cities will see it, and they will potentially be looking to acquire this technology from Ouster, and they're gonna be paying Ouster recurring revenues, fees, pretty much every single month, which is why I really love this business model, and it differentiates the company versus other LiDAR companies that are killing themselves in the automotive LiDAR space. Something else for Ouster, which is really a newish segment, is mainly the defense segment. And this is what really gives the company some kind of a moat or a competitive advantage. And I'm going to read this again from the earnings report. And it says, Ouster's OS1 became the first and only 3D LiDAR sensor to be approved and certified by the US Department of Defense for use in unmanned aerial systems. This sets Ouster apart as a trusted solution for the government application and positions us well to benefit from the US government's effort to strengthen the domestic industrial base for critical technologies and promote trustworthy supply chain. And they also won an award to provide, security for US Army base and a few other things. But the main message is Ouster is the only LiDAR sensor that could be used for autonomous applications within the Department of Defense, meaning autonomous drones. For example, Anduril, which is a popular company, they use Ouster LiDAR sensors in their drones. and a few other companies also. So that gives company a competitive edge because most of those sensors, they don't qualify because they don't meet the new made in USA standards. It has to be made in USA. It has to have a lot of different things to qualify. And Ouster is the only one that could be used. And this is a major tailwind in terms of drones. And that only happened a few months ago. Now, in terms of the business model in general, I told you this is a company that's selling sensors and it's selling hardware, some software, but mainly hardware. And maybe you believe that the gross margins are like 5%, 8%, 6%. Their gross margins are actually 45%, 45% gross margins. So if there was so much competition on Ouster, if that was so competitive, how comes they're putting up 45% gross margins? This is because Ouster is not in automotive LiDAR. They specialize in industrial LiDAR, in robotics, and they have the software business. And over there, they have more pricing power because their sensors are more designed for those applications versus the competition, which their sensors are mainly designed for automotive applications. They have more of pricing power. They have a competitive advantage. And I forgot to mention that a big competitor to Ouster is, I believe, Hesai, this is how you pronounce it, which is a Chinese company. But the Chinese company got blacklisted from the US government, and it cannot be used for any Department of Defense contracts or any smart cities or traffic monitoring systems in the United States, which also, again, helps Ouster stand out, at least in the United States. And they have their 45% gross margins, which is very interesting. The last quarter was actually very good, 30% revenue growth, 52% non-GAAP gross margin. So things have been improving. The company is unprofitable and is expected to be profitable by Q1 of 2027. As you could see here, it has been improving losses from 71 cents in December of 23. It's been improving every quarter. Now it's at negative 18 cents and it's improving, step by step. So this is a process, and as they're not focused on profitability, they're focused on growth and their competitive advantage. And I believe this is what they should be focused on as they are in their early stages of the cycle. Now, the bad thing about investing in a company is the dilution. They dilute a lot of stock because they're unprofitable. And you can see shares outstanding have ballooned over the last few quarters. But the company, on the latest call, they mentioned that they have enough cash until they become profitable. And now I believe they have 240 million of cash and no debt. So hopefully that should be enough, and they're not going to dilute more shareholders over the next few quarters. And I'm hoping the dilution doesn't continue. But this is common with early stage companies. Once they turn profitable, the dilution starts to get less and less over time. And once the company becomes mature, then they start buying back stock and doing dividends. All companies pretty much go through the same cycle. And this one is very early in its business cycle. Now, in terms of the growth, they're expecting 30 to 50% annual revenue growth. You have very few companies having a long-term target, not just this year, long-term, over the next 5 to 10 years, to grow 30 to 50%. I think the company can easily do it because they are in the early innings of industrial automation. They are the leader in the space. You have the smart city potential. This is a $70 billion TAM in total alone, and the company's revenues is $143 million. So they can 10x the revenues, and it's not even close to having maybe 5 or 6% of the total TAM, or maybe around the 7 or 8%. It's not even close. So they have such a long runways that I believe they can do 30, 40% for the next 10 years. I think this is highly, highly achievable for a company like Ouster. So for my valuation model, this is what I'm using. I'm using the current revenues of 145 million for 2025. For the next 10 years, I think it's highly achievable again because the company is small and the TAM is so huge. Over the next 10 years, this is $2.9 billion in revenues. We're going to round it up to $3 billion for simplicity. Now we look at the price to sales multiple. It's trading at 10, but it's not actually trading at 10. The system hasn't updated yet. It should be trading around 9 times because they pulled back 14% today. Actually, around 8.8 it should be trading. But it's trading at 10 times. And it did get a multiple expansion, as you could see here. And that was the pullback, the kind of pushback that I got on my latest video, is that I got a multiple expansion. And this is true. It got a multiple expansion because there's only one approved for defense right now. And the company is getting better in general. They're losing less money. And the stock got discovered. Once they get discovered, it's very hard to buy it back at 2 and 3 and 4 times sales. I don't think it's ever going back there. I mean, maybe, but I highly, highly doubt it. But I'm going to use 5 times sales and 10 times sales for my valuation model. Okay? So I'm going to take the 3 billion and we're going to put it here. This is 3 billion, and I'm going to time it by 10 times sales. Easy calculation, $30 billion in total. I'm losing enterprise value over here, and the current enterprise value it's showing as 1.68 billion, but it's actually 1.48 billion because again the stock pulled back a little bit. So I'm going to divide that by 148 billion. In total, I'm getting, around 1,927% on the upside over the next 10 years. Now, if they do dilute some stocks, maybe instead of an 18 or 19x, maybe that's like a 14 or 15x, it's not such a bad return. And I know it sounds crazy, but I believe the 35% revenue growth is sustainable. Small company, huge TAM. And I believe the 10 times sales could potentially be sustainable because the company, even 10 years from now, we would still not even be in mid-stage of the automation process. So I think 10 times would be sustainable. But I'm going to use 5 times to have a different case scenario. So I'm going to take the 3 billion, time it by 5 times. This is $15 billion enterprise value. I'm going to divide it by 148. In total, I would be getting around a 10x, or you could say a 9x over the next 10 years. Still not a bad return for a company like Ouster. So for me, this is why I own the company. This is the upside that I'm seeing. Of course, nothing is guaranteed on the stock, but that's why I'm owning it. I told you it's a little bit speculative, and if you're not willing to take 15-20% days, then don't buy Ouster. It's very, very volatile. But I personally love the volatility because I can take advantage of Mr. Market's mistakes. So if Ouster, for example, goes back to $10 and the company is still growing, as a long-term investor, this is amazing. I get to buy more at a lower price. I love it. So this is my mindset, and I don't know if you have the same mindset, but that's how I think about it. And my cost basis, I started at $21, then I averaged up. I started here at $21, then I averaged up around $30. I bought a little bit more after the earnings report. The company proves itself. I buy a little bit more. That's how I go with it. So my cost basis, I believe, is around $24 right now, or $23. And that's my thesis on Ouster. And by the way, I'm using Fiscal.AI to come up with all those charts. And if you want to try it out, they give you 2 weeks of free access if you use my link down into the description. Now, the second one, which I talked about it many times, I'm going to talk about it again. My favorite stock, by the way, is Mama, which is Mama's Creations. It's a interesting company. I started buying this one at $1.74. It was like 65 million market cap. Since then, it's up like 429% over the last 5 years. I talked about it at $2 on YouTube, $5. I talked about it last time, was around $9.80, I believe. And the stock just keeps on going. It just keeps on executing. Now, Mama's Creations is a food company. They sell meatballs. This is their traditional legacy product, but they also have salads, pasta, olives, sandwiches, and they're acquiring other kind of things like sushi and pizzas, and they're acquiring other companies and expanding into new areas in general. They sell at Walmart. It was a new expansion, so there's a lot of potential over there, but their legacy customers are BJ's, Publix. Publix is a huge one for them, Costco, and Costco actually was also maybe like an expansion last year, Whole Foods and a few others, but mainly BJ's and Publix. Those are their legacy customers. The CEO, I love him. This is why I'm in the company, because of the CEO. And his saying is margin, margin, and then margin. Then he always says that what gets measured gets improved. So he measures everything, even the cost of gas. He measures how if they're running the AC too much and if they can save money on AC or whatever. And he measures everything. Just watch an interview or listen to the earnings call, you're going to understand. He measures every tiny detail, and he cares about margins a lot. So since he came in as CEO, he took margins from 12% to 25% gross margins. And this is the beauty about this business, is the more they expand their SKUs, their SKUs, or their product mix within one retailer, the higher their margins would be. So let's say they have a truck going to Publix. They sell meatballs to Publix. If they can sell their salads and their olives and their sushi to Publix, then you have 4 more SKUs, and the cost of shipping or logistics is the same because the truck is already going there, and that massively increases the profit margins of the company. So it's an amazing, amazing business model, and it's mainly a recession-resistant business model, you could say. They have exponentially grown their revenues over the last few years, which has been amazing. Now, the company's goal is to become a $1 billion company in sales by 2030. This is the vision, and it might seem far away because the company's revenues are in the $200 million range total, and maybe it seems impossible, but I'm going to show you a few case scenarios and tell you why I still like the company despite the target being a little bit too high. But for the latest news on the company, they acquired an acquisition. It was from Crown Rock. It was a company from Cisco, which was a good acquisition. It's going to add 56 million of revenues. Now, for 56 million in revenues, they paid 17.5 million in cash. So they got a steal, they got a deal on the company. It was very, very cheap, which was 0.3 times revenues. The CEO was waiting for over a year to do this acquisition. He always says that I want to acquire a company, but I'm not going to overpay. I'm going to keep waiting. I'm going to be disciplined, and I'm not going to overpay. And he found it. And this is a gold mine, not because he's getting 56 million of revenues for only 17.5 million, but it's all the other things that are coming with it, because that was a new facility from Cisco. They put in like 6 million into the facility. It has all the new automated equipment. It has everything the company needs. So the analyst asked him on the call, do you need to put in any CapEx in the new warehouse or in the new actually factory that comes in with the acquisition? And this is what he said. He said, we do not expect any major CapEx whatsoever to Crown business. If anything, we're actually going to take some stuff that maybe is underutilized and bring it to the other factory where we would be going to buy something completely new, and now we don't have to. So they're saving money on that because all the equipment there is new, so they can use it for other things. This is, again, it was a steal of an acquisition. He said, I would argue from a system perspective, it's like a net negative CapEx. So that was the deal of the century. They got it for 0.3 times revenues, and it's going to take their total net revenues 220 million. The CEO is not stopping here, and it's going to be an acquisition pretty much every year or two acquisition until he gets to $1 billion in sales by 2030. And he doesn't dilute stock too much, which is why I invested in the company. He mostly uses debt, he uses cash, but he does his best not to dilute stock, and he doesn't overpay for acquisitions. But for the company, I'm going to use something very simple. I'm going to assume that the CEO, he delivers again, and he hits $1 billion in sales by 2030, so 5 years from now, okay? Now, he did give guidance of long-term net income margins of 10%, and this is normally what food companies put up, 10 to 15%, maybe 12% net income margins. So I'm going to use 10%. This is an easy calculation. We get $100 million in net income. I'm going to time it by 20 times earnings. I think 20 times earnings for such business that it would still be in its early days, it would still be growing. I think this is fair. That would be a $2 billion market cap. The current market cap right now is 427 million. So total upside from here would be around 368% over the next 5 years, which is still not bad at all, in my opinion. And I believe the potential multiple would be a little bit higher. I think, a lot of things could potentially be better. But again, 368% over the next 5 years is not bad. When I talked about it last time, it was a 450%. The stock has gone up a little bit since then. But from here, I'm seeing 368% on the upside, and I think this is highly achievable. So this is my thesis on Mama. 368% on Ouster. It's not profitable, but it's higher risk, higher reward, up to a 17, 18x over the next 10 years. This one is you could say a 3 to 4x in 5 years. Over the next 10 years could be a 7 or 8x in my personal opinions. But that's my opinion on Mama, and that's my opinion on Ouster, and that's just the stocks that I own. It's not financial advice. I'm not telling you to buy them. I'm not telling you to do anything. You could feel free to do what you like. And again, just my opinion. Thank you for watching, and I talk to you in another video.